Well, hello everyone and welcome. Cynthia Tomaine here with Interactive Brokers, and thank you for joining today's webinar being brought to you in conjunction with our exchange partner, the Singapore Exchange. I'm very pleased to have with us today Tariq Dennison, who is a wealth manager with GFM Asset Management in Hong Kong. Tariq is going to be delivering today's presentation. So with that, Tariq, I'm going to go ahead and pass you the controls. If you could share your desktop, let's get underway. Thanks for joining us, Tariq.
Thank you very much for having me, Cynthia. It's great to be back. So I'll go ahead and I'll click the Start Broadcast button.
Oh, it's already started. We're good.
Excellent. Okay. All right, and I see we're getting attendees online, and the grace period for joining us passed, so we're all ready to go. Well, thank you all for joining today's presentation. As you see, the title of the presentation is After the Virus, Trading China's Recovery via Stock and Currency Futures. And as always, I find a challenge of not only deciding what to put in the presentation, but what not to put in the presentation. I will let you know in advance, this is one of the longer ones that I have done so far. It has a total of 50 slides, and I will try my best to give you a concise and focused update on the most important things that you need to know about the Greater China market after the virus to the extent possible. To start this, of course, I had to choose an initial cover picture. You'll notice here I have the picture of the Wuhan train station right after the lockdown was lifted. And that is one of many data points we'll be looking at and trying to get a picture of how quickly is Greater China's economy coming back, how should we look at its markets in that context, and what clue does that mean for the rest of the world. Now, before I continue, I first need to show you a disclaimer. Next, we have one more disclaimer by Singapore Exchange. Excellent. So now with the disclaimers out of the way, I'd like to take a few seconds and introduce myself for those of you who have may not attended one of my webinars before. My name is Tariq Dennison. I am a trust and estate planner and an IFPHK certified financial planner based here in Hong Kong. I am an independent advisor and manager of investment accounts on the Interactive Brokers platform. So I'm one of the advisors that you can find in the Interactive Brokers marketplace. Actually, and you can find my firm under two different names under two different legal jurisdictions. One is in the US. This is for accounts outside of Hong Kong, Australia, and a few other locations under the name of the firm GFM Asset Management LLC. And I am based in Hong Kong and also have a Hong Kong Type 9 licensed asset management firm under the name GFM Group Limited. So if you have an Interactive Brokers account either in the US or in Hong Kong, our advisor firm is usually able to manage all of our, or a partition of it, under the Interactive Brokers platform as an advisor account. Personally, I have 22 years of experience in global markets, working for top-tier investment banks, including Commerzbank in New York, London, and Frankfurt, Bear Stearns and JP Morgan in New York, the Canadian Imperial Bank of Commerce, also known as CIBC, in Toronto and London, and then Societe Generale here in Hong Kong before starting my own firm, GFM, in 2014. I have a master's in financial engineering from the University of California at Berkeley, and I'm a visiting professor of fixed income and alternative investments at Essex Business School in Singapore. My book is titled Invest Outside the Box, Understanding Different Asset Classes and Strategies, and you can find a copy of that on Amazon as well as with the publisher. Now, let's take a look at the two different parts of the presentation that I want to discuss when discussing the Greater China markets and action plans for how to invest and how to trade these markets. First of all, the fundamentals. First of all, I said we're going to talk about Greater China, so I need to start with the definition. What is Greater China? Second of all, although those of you who are attending probably have an answer to this, the question is why Greater China? Why are we focusing on this specific region? Why aren't we just trading the FANG stocks in the US like everybody else? Next, when we look at the Greater China markets, we have different types of data sources that we want to look at. First of all, we want to look at some of the official data sources. But given a lot of the skepticism that there is over official data coming out of different parts of China, I also want to mention some sources of alternative data. And this is really quite important when we talk about all of the scattered points of view and scattered types of data that we get about Greater China and different parts of the China markets. And I'm only going to be able to really do a very high-level overview of some of the different angles we might look at here. Next, I'm going to give a bit of an outlook of what to expect after the virus and after the trade war. Even though these may have damaged certain sectors of the Chinese economy, certainly certain export sectors, certain consumer sectors, it has affected different sectors of the China market in different ways and at different times. Same exact thing with the trade war. And so we need to look at different timelines and different levels of impact for these different sectors. I'm then going to look at drivers for the different currencies. And the two different currencies we're going to talk about here are the new Taiwan dollar and the Chinese yuan renminbi. A little bit about the history of them and how to look at those currencies going forward. And then the breakdown of the Greater China indices. The main ones we're going to look at here are the A50, the Msci China Free, and the Msci Taiwan. I'm going to explain what those different benchmarks are and how their components and sector breakdowns differ. Now, on the right side of the slide, we need to get into action plans. All of this study of the Greater China market is only useful if we can find a way to make money from it, to actually position our portfolios with stock positions, futures positions, currency positions to give us better returns, again, than just simply buying the FANG stocks and hoping for the best. So part of what I'm going to be presenting there is an outline of each of these different futures contracts, the A50 futures contract, the Msci China futures contract, the Msci Taiwan futures contract, all of which track stock indices. And then I'm also going to look at the Renminbi currency futures contract traded on the Singapore Exchange, one of 3 exchanges where it's fairly liquid to trade the Renminbi. And I'm going to come up with I'm going to present a few sample trading strategies, both long and short side trading strategies. So even though I'm very much talking about the overall outlook of China here, I'm going to be presenting both the good and the bad, the bear and the bull cases. And so if you're bearish, you might want to look at the short strategies and look at how to use these futures contracts in order to put on short positions or to hedge exposure in markets that you believe are going to decline. So first of all, I said we needed to start with a definition of what is Greater China. Greater China is a business term. It's a definition used by business people, mostly based in Hong Kong and other Asian financial centers, to really dodge the political question. I am not here to talk about politics, but when we say Greater China, we are broadly including mainland China, we are including the special administrative regions of the People's Republic of China, Hong Kong and Macau, and we are including Taiwan. This broadly refers to the markets where you can mostly get business done by speaking Chinese, by writing in Chinese characters, and it's largely a linguistic and cultural definition for those of us who simply want to do business and make money from Greater China markets. In that way, when we look at Greater China, even though Taiwan and mainland China have different currencies, different legal systems, and really very, very different equity markets, which are hard to even trade together, they're allocated separately in many equity portfolios, but we look at them as one unified unit, pretty much the same way as we look at New York Stock Exchange stocks and NASDAQ stocks together in an index like the S&P 500. Another way that I like to look at Greater China, rather than looking at it as different currencies or different passport issuers or different tax jurisdictions, I find it useful to look at cities. So in this case, if we look at Shenzhen, Shanghai, Hong Kong, and Taipei as 4 financial centers, 4 different cities with stock exchanges on which we're going to be trading different investments, whether it be healthcare stocks or liquor stocks or banks, that also gives us a different way of looking at it. And even though Macau is one of these, Macau is a little city and it does have a currency, it does have a different immigration regime, it is so small and it doesn't really have its own separate market that any Macanese companies you're likely to trade pretty much trade in Hong Kong, and you may as well treat them as part of Hong Kong from a market point of view. So this overall map that I want to kind of give you here, when you look at Shanghai, you have the A share and the B share market, Shenzhen, the A share and the B share market. The difference between the A share and the B shares is a historic one. Back in the early 1990s, the B shares were the only ways foreigners could invest in Chinese stocks. Nowadays, the B shares are kind of an older sideshow to how foreigners invest in mainland Chinese stocks, because we can now buy A shares directly through Stock Connect. Strangely enough, if you asked me 20 years ago, would I be able to access and trade stocks in Shanghai more easily than I can trade stocks in Taipei in my Interactive Brokers account, I would have said probably not likely. That sure is the case today. If you log into your Interactive Brokers account, you can trade A shares listed in Shanghai, Shenzhen, or Hong Kong equally easily. You cannot access single stocks listed in Taipei. So that's one of the reasons that we look at those different parts through futures markets and through other access products as well. So that's the quick overview of what is Greater China. So now that we've defined what is Greater China, we next need to ask why Greater China. And here I must apologize to those of you my age and older. I'm going to be using a few memes, a few pairs of pictures you have probably seen shared on social media over the past few years. This particular one is a well-known and well-shared one. It's a picture of Shanghai in the early 1990s versus fairly recently before the finance center went up in Shanghai. And it's really just meant to show you that over a 20-year period, how quickly has the Pudong side of Shanghai developed, how many of those high-rise buildings in Shanghai come up in just the past 20 years. Now, if you look at Taipei, much of Taipei still looks much as it did in the 1980s. Taipei 101, of course, went up in the mid-1990s, but it hasn't developed quite the same speed as many mainland Chinese cities. And of course, if you're used to North American cities or many European cities, the level of development that you would have seen in mainland China is truly breathtaking and relatively breakneck speed. So from a pure point of interest of dynamism, how much things change, how much you can expect different rates of return just because things don't stay the same. And people are getting richer, new consumers are being minted left, right, and center. There are now more Chinese billionaires than American billionaires. Those are the types of trends, mega trends, that we are, in my view, still in the middle of, that make this a very exciting market to take a look at. Now, meme number 2 is another one that you may have heard. This was, I believe, originally posted by a Brazilian blogger or Brazilian source. One of you might correct me on the source of this. On the left, it shows how the metro system in Rio de Janeiro, Brazil, changed over the 20 years between 1993 and 2013. So over those 20 years, the same 2 metro lines in Rio de Janeiro are still there. It had not added any new metro lines, and it only added a few new stops to the existing metro lines. On the right-hand side, on the other hand, you'll notice that in 1993, Shanghai did not have a metro system, if you can believe that. On the lower right-hand side, you will see what Shanghai's metro system looked like in 2013. So this is really an underground version of the previous slide, showing again how quickly, how rapidly, how almost blindingly fast China's development has happened. And I must admit, I haven't been to mainland China since last November, pretty much since we've had 14-day quarantine and other measures in place. But that's one of the reasons that I get excited every time I go there. Shanghai is just one of many cities I go to, and I truly still feel a level of energy there that I still don't even feel here in Hong Kong, let alone in other cities. Meme number 3 is one that I will hear different opinions on whenever I talk about China's market. Within just the past week, and I wasn't able to get the slide in on time, there was the update on President Trump saying he wanted to stop U.S. government pensions from investing in Chinese stocks. And when this went up on one of the forums on Seeking Alpha, of course, there are a wide variety of opinions. But as you can probably guess, at least half of those comments were quite hateful towards China and say, well, yes, of course, why do we want to invest in China? There are all these fraudulent companies. There are all these other reasons why people say that you shouldn't trust any data coming out of China. And that's the point of this slide, showing the two-letter switch between fact and fake, which in my view, I very much see as a two-edged sword. I have lived here in Hong Kong for 10 years, and I've done business with China for a lot longer than 10 years, even when I was living in New York and would fly over here fairly regularly. And I realized that we just have to get used to the fact that the standards of disclosure here, the quality of data that we get out of many Chinese companies is simply not the level that we are used to with, say, many US companies or many British companies. Now, you can view that as a risk factor, or you can also view it as an opportunity. If you ask me which market benchmark would be easier to beat by an active manager who can do a little bit of homework and avoid some traps, I believe it is much easier to outperform the CSI 300 than it is to outperform the S&P 500. Because I believe whenever you have people afraid of fake data, afraid of standards of disclosure, and inefficiencies in reporting standards, there is opportunity for those who are willing to do a little bit of homework. So that's one reason that I very much highlight the inefficiency as opportunity, even though here I've presented it as a meme. So next, I said I wanted to try and present not just memes and pictures, but I wanted to try to present a few different facts and figures. And first, I wanted to start with official facts and figures. This first one is a chart from the IMF, really just showing what is the overall size of the Chinese economy compared with a few other economies, both in the rest of Greater China and with the US, which is still the world's largest economy. And over this time frame, the IMF data starts back in 1980, so not really going that far back if you want to think historically, and ends in 2020. So this one doesn't include any of the future projections that you would get in the WEO database. But what I want to point out here is if you go back to 1980, the mainland China's GDP was actually not that much larger than Taiwan's GDP in 1980, which is really remarkable when you consider how many times larger mainland China's population is when compared with Taiwan's. And you'll notice it didn't really grow that quickly until the 1990s when you started seeing some of the reforms, and then in the early 2000s when China joined the World Trade Organization. The growth that we've seen since then was that level that we saw in those Shanghai pictures, where the skyscrapers went up, the metro systems got built, and in 2014, on a purchasing power parity basis, that means not looking at money on the official exchange rates, but we look at the actual amount of stuff traded in the economy, China's economy surpassed the US economy in terms of size. That means in terms of energy consumption, in terms of number of televisions and iPhones and refrigerators and cars purchased, China is already doing more of that than the US economy is doing. Now again, this is purchasing power parity. There are those who will be skeptical of it, but in terms of overall size, there is no doubt this is a measure that China's economy is way too big to ignore. And it has been growing very quickly, and there is opportunity there if you know how to capture it. The other way of looking at purchasing power parity is that it is sometimes a measure of relative value of the two currencies. The fact that China's economy is larger on a PPP basis, but smaller on a net exchange rate basis, is a sign, according to this measure, that the renminbi is still relatively undervalued. So that's going to come into play later on when we talk about the currency. So I mentioned purchasing power parity GDP versus official GDP or non-purchasing power parity. This is a slide that I got from another fund provider, which shows the discrepancy between the percentage of the world economy versus the percentage in world benchmark or world fund weightings. If you own, for example, the Vanguard All World Index Fund, so in theory, an index fund, passive tracker that gives you access to every stock in the world, only 4.2% of that fund is allocated to China, despite the fact that it is the second largest economy, despite the fact that China's economy is 3 times the size of Japan's economy. Only half as much is allocated to Chinese stocks as to Japanese stocks. And if you look by proportion, 1/12 as much is allocated to Chinese stocks as to US stocks, even though China's economy on a purchasing power parity basis is more than 60% of the US economy, and roughly the same size as Europe's economy. So there can be many ways of debating what is the right way of weighting your overall global stock portfolio. I would argue that it at least should be in line with the size of overall economies. Definitely not as out of proportion as this. Now, personally, I don't even think GDP weighting goes far enough. I prefer to weight my portfolios by opportunity. I prefer to invest more in markets where there are higher expected returns and less in markets where there are lower expected returns. But of course, all of those are different views there. If you were a follower of someone like Carson Block or Muddy Waters, and you find that Chinese companies with very high valuations, like say Luckin Coffee, provide good opportunities for short sellers, that also gives you opportunity on the short side if that's the way that you want to look at it. But again, you will find more Luckin Coffees by looking for things like that than you will trying to find the same opportunities in US or European coffee companies. So on the next slide, I also want to show that even if you step away from all world, total world funds, if you look at emerging market funds, so by one statistic, I saw that there's 10 times as much allocated by American investors to China by the portion of their emerging markets funds that are allocated to China that are actually allocated to China funds. What that tells me is 90% of Americans do not know how much their retirement plans are allocated to China. They just simply buy an emerging market fund, and that's exposed to whatever emerging markets that may well be. Well, many, many years ago, back in the late 1980s, early 1990s, Argentina and Malaysia were the two largest emerging markets. In 2000, South Korea was the largest emerging market. Now, by far, mainland China is the largest emerging market. And if you look at Greater China, that includes China A, China H, overseas China, Taiwan, and Hong Kong's own market, Greater China accounts for over 50% of your emerging market fund. So even if you don't know it, even if you're just buying a plain old emerging market fund, this market is way too large a share of that market to not at least pay attention to and have some interest in what it's doing. So that's why I spend so much time looking at it and at least trying to give you an educated perspective of whether you're bullish or bearish, whether you think there's opportunity to buy bargains or opportunity to short overvalued opportunities. I feel there's time worth looking into it and studying it. So on to a few more official numbers. Part 2, I wanted to compare China to other markets in Asia. And really what I wanted to show here is we show overall trends in growth of China, India, Japan, Korea, and then what are sometimes called the MTIP markets, Malaysia, Thailand, Indonesia, and Philippines. And overall, we tend to see more or less common rates of growth across these different markets. We notice that, Southeast Asia has grown a little bit faster than Japan, but that blue line along the top is Japan. It grew really, really well throughout the 1980s, and it had its big bubble in 1989, 1990, and Japan's economy really hasn't grown since then. China's economy in 1980 was slightly smaller than India's, but it surpassed India's. Then later on, it surpassed Japan's, and as I mentioned, in 2014, it surpassed the U.S.'s. This is all on a log scale. So when you consider in the 1990s, we had the boom in the other Southeast Asian economies. We had kind of other markets going up and down during and after the global financial crisis. This, again, is the type of picture we want to look at when we want to see how have different economies in this region gone from being in the middle of the pack to being at the top of the pack. Don't get me wrong, I've done other presentations on Southeast Asia, and I'm doing a presentation next month on India. These other markets have other opportunities as well, but the one here that, again, I highlight is China went from the middle of this chart to the top of this chart, and the question is, do you think that over the next 20 years, they're going to continue that trend and more or less stay on top? So the next slide of official data is one that has nothing to do with GDP, economy, market weightings, but has to do with the current issue on every news channel, which is, of course, coronavirus, COVID-19. This chart is already a few days old, actually almost a month old now. It was last updated on April 28th. And what this shows is how the number of active cases has evolved since case number 100 was reported in each of these different countries. And the point here really to show is that back in late January, early February, I remember at that time, we still very much viewed the coronavirus as a China problem. In fact, very specifically, it was a Hubei province problem. And at that time, I was still flying to Singapore back and forth every single week. It had gone from being no problem to them asking, have I been to Hubei province, to being asking, have I been to mainland China within the past 14 days? It was still very much a mainland China problem at that time. But then, within 30 days after case 100 in mainland China, cases peaked, and then they started slowing down. It started to get under control. And then by mid-March, when Europe, when Italy, when New York City was really starting to get hit by it, when markets were absolutely plummeting, I was already speaking to my contacts in Shanghai and Shenzhen, who said by then, mainland Chinese cities were largely already seeing the virus behind them. So part of the reason I bring this up to say is even if you don't believe the numbers from China, the reported numbers in different countries are 100% accurate, the fact is, time-wise, they are a month or two ahead of the curve. And if you want to understand what's going to happen in different economies, plus or minus a few weeks, plus or minus a few thousand here or there, look at how it's been handled there. Look at how kids in mainland Chinese cities are going back to school, how people there are going back to restaurants, and that will give you an idea of how it's handled. I also get asked on a relative basis, how is it that, for example, only 9 people have died from COVID in Beijing, whereas how many thousand have died in New York City? And there are a number of answers I could possibly give to that. One is, of course, how seriously people over here in Asia have taken this whole thing. But also there are a number of other things too. One example that I gave was when I saw TV footage of the New York City subway being wiped down and cleaned, I realized that in the 5 years I lived in New York City, I never saw that. Whereas when I ride metro systems in Asia, in Singapore and Shanghai and Hong Kong, I see those things cleaned very regularly all the time. And that's just being one factor. That, wearing masks, taking off shoes when you go inside, I believe all those factors can really add up in terms of how much this spreads in place to place. Also, don't forget, in this part of the world, we've had SARS, we've had swine flu, we've had MERS, and we've been used to it. Many of those things haven't hit Europe and the United States in quite the same way. So there are a lot of reasons why I feel, understandably, many Asian countries with higher populations have been lower on this curve than places like the UK, Spain, Italy, and the United States. So important chart here, but of course, does need to be updated as we go along with it. So that's it for official data. Now when I talk about alternative data, I also want to point out that there's alternative official data and then truly alternative data. So let's go through this one at a time. Now, first of all, even though it is official data, when we look at reports of listed Chinese companies, that is not the same as officially reported statistics from a government or from the WHO or sources like that. Those, of course, always have things that we need to check for red flags, but that is something that we can sanity check. When a Chinese company decides to raise its dividend, that can be a signal, but that's something that is awfully hard to fake more than once. It's awfully hard to fake over longer periods of time. You also find that many analysts tend to look at one financial reported metric or another, and so if you look more holistically at reported financials, you can often find patterns that will add up in one case and not in others. And so just simply doing your math and doing your homework on reported financials, I still feel can add up to an awful lot, even though it's, of course, not foolproof by itself. Another thing worth checking is reports of trading partners. Now, this can be between governments. So let's say, for example, if the US says it's importing less from China and China says it's exporting more to the US, that's one thing that you're going to want to check out. When you look at Korea's numbers, Korea trades a lot with China. If Korea is reporting a big slump and China's not reporting the same amount, we can, of course, check China's numbers with Korea's numbers. Same with all of its other trading partners in the region, Japan, Singapore, Germany. We look at that again, and that's on a government level. We also then want to look on the company level. So if we look at Apple, if we look at Starbucks, if we look at other US companies that report what they're doing in China, if Apple is reporting lower sales in China, That's an alternative data point. And clearly they're going to report how much they're able to bring back. And as we saw, Apple reopened their stores in China when they shut them down almost everywhere else. So that's another example here. That's where I talk about looking at reports of foreign companies doing business in China. That includes publicly listed companies, their reports. It also includes Nielsen reports, whatever other data that you can get. All of this I include under the category of alternative official data. So now when we move on to the category of truly alternative or even more alternative data, some of this includes on-the-ground information. So I mentioned earlier that in mid-March, I had several calls with contacts and clients who are in different cities in mainland China, and they were giving me their perspectives on the ground of what was it like in Shanghai. How many people are outside? Are people still wearing masks? Are you still taking temperatures when you go into shopping malls? To some extent, there's really no substitute for that kind of in-person conversation. And as mentioned, since November, I have not had the benefit of being able to go to Shanghai or to Wuhan and checking it out myself, but at least I can get on WeChat, and I have about 100 people that I can check in these different cities who at least give me some view about it. I have mentioned that as soon as I don't have to worry about being locked for 14 days, I'd love to go to Wuhan and some of these other cities and see what it's like firsthand. Another alternative data point to check are all overseas purchases by Chinese. So this includes, for example, Vancouver apartment listings, or Sydney or Melbourne or other places outside of China where Chinese buyers and Chinese money have been a big part of overall demand. I mentioned, of course, apartments. That can also include luxury goods. It can include duty-free purchases. There are lots of these other metrics that you can look at to say, has China recovered? And overall, is the Chinese consumer traveling again, or are they going overseas? The part of that to check, of course, is that those of us who are here in Greater China, even though we have our own travel restrictions, I have to tell you right now, we are not in a hurry to travel to Milan and to New York City. So even though that is an alternative data point, it is one that you do need to check against other travel concerns that we may have. It's not just a China data point, it's a destination data point as well. The next data point I'm going to mention, and I'm going to show in my next slide, is satellite images. So this includes satellite images of air pollution, traffic, and other sorts of things, which again are very, very hard to fake, but it will give you an idea of how much people moving around in different cities. So this next slide, as mentioned, is one that you may have seen shared already, and versions of this, I believe, were shared on my Facebook page in advertising this event. It shows what was air pollution like in northern China on January 1st to 20th of 2020, and then 1 month later, or a month and a half later, in mid-February. This really shows what the effect of that lockdown was. If you've traveled to Beijing, or if you've traveled to many busy Chinese cities, you know that air pollution is a very, very serious problem. And this morning in the Financial Times, it was reported that global air pollution, global carbon emissions, were down 17%. And that gives you an idea of the reduction of economic activity. Maybe not entirely, because if we're sitting at home and working from home rather than driving, some of us who are white-collar workers may still be productive. We're just doing it without driving. On the other hand, factories that are not working and Amazon trucks that are not going around delivering stuff is a sign of overall reduced economic activity. So again, this is just one other alternative data point that you can check. I want to try to keep this under an hour, but this gives you an idea of all of the different angles you can look at this from, rather than just the official reported numbers. Now, I'm mentioning very much the coronavirus, COVID, the outbreak, containing it as one of the big current events to look at. But we can't forget that just before this, we were also talking about a trade war. And the two are not entirely unrelated. The fact that this outbreak has been taking place has very much brought to the forefront of people's minds, well, what do we do about supply chains? Are we still going to be pivoting supply chains away from China like President Trump of the United States would like to do? Well, some of the shift of supply chains out of China has been a work in progress for a long time. But this is unfortunately a problem which is much more complicated than anything one president or two leaders or two cabinets can possibly solve. I think this is something that we're going to need to view not just month by month, but we're going to need to view sector by sector. The fact is, 6 months from now, if Chinese exports to the US go down, that could be for a variety of reasons. It could be because of a shift of supply chains. Could be because of a deepening of a recession in the United States. It could be because of an increase in automation. It could be because of a rise of Chinese consumers. There are a number of reasons that we could look at. So even though we say that there's a lot of uncertainty about the trade war, that's why I've ultimately gone to more and more of a micro level and had to try and look at individual companies and individual scenarios on those companies to say, for a name like Guizhou Maotai, it currently does not really rely that much on the trade war because the US isn't importing a heck of a lot of that. Guizhou Maotai still has a lot of work to do to get Americans to like the taste of its spirits. So one example of a name that's not very much exposed to the trade war, unlike, let's say, an exporter or a manufacturer of iPhones, where if Apple moves its production of iPhones to India or Texas, it's going to have a much greater impact on U.S.-China trade than it would on a name like, say, Guizhou Maotai. Another theme, which I think is a broader picture than just the U.S.-China trade war, it really is the whole question of Belt and Road. This is something which, again, a lot of people have a lot of different opinions and a lot of different views on, but this is a mega trend which I think is, again, way too big to ignore. Those of you who followed me on Instagram know that in 2017, the trip that I took with my two sons was along the Karakoram Highway from Urumqi to Kashgar all the way to the border with Pakistan, because I wanted to show how much Greater China, or how much specifically Beijing, was investing in its second C, basically its second connection to Central Asia, to Russia, to Europe, overland through Central Asia to get around India. One big difference between China and the US, even though China and the US are roughly the same size geographically, is that China is really only surrounded by one ocean. And if you've been to the northwestern part of China, you know that it is about as far from the sea as you can get. And most of global trade really still goes by sea, by ocean. So if that side of the country is going to be better connected, they've needed to invest in road, they've needed to invest in rails, and that's going to mean not just greater opportunity and greater trade for China itself, but for lots of different Central Asian economies as well. One of our best investments so far this year was is a Kazakhstan-based uranium miner listed on the London Stock Exchange. Very much a Belt and Road trade, very much a name that hasn't been hit by COVID so far, because even though oil and other energy prices have been going down, we're still using electricity, and I'm still talking to you over a network that half of you are probably finding is powered by nuclear power. So uranium from Kazakhstan is still very much powering a lot of different markets in this area. So definitely watch this space, definitely watch the routes on this map, and note that it's not just a US-China story. It is a China versus rest of the world, or at least China versus the rest of the Eastern Hemisphere story that very much watch this space over the next 10 to 20 years. So now on to some actionable trade ideas. I've been talking a lot so far about the coronavirus, trade war, economics, macro trends in Belt and Road, but let's talk about numbers that move on screen, that when they move, you can make money if you trade them in the right direction. First thing I want to talk about are currencies. Now, in this case, I wanted to plot two of the major currencies of Greater China that you can trade in one form or another. One is the new Taiwan dollar, and the other one is the Chinese yuan renminbi. So when I mention new Taiwan dollar was redenominated in 1949 after a period of hyperinflation during a civil war. And the data that I have is really only begins from 1983. So from that period, from 1983, the new Taiwan dollar had appreciated during the 1980s, more or less in line with the Japanese yen. In many ways, if you look at the development of Taiwan, it actually follows the development of Japan a lot more than it has followed the development of mainland China. Meanwhile, the renminbi had actually suffered great periods of devaluation throughout the 1980s and 1990s, which is something that a lot of our younger listeners may have forgotten. When I first arrived in when I first moved to Hong Kong in 2010, the renminbi was viewed as a one-way bet of appreciation. That's that later part of the trade where you notice the renminbi was very, very stable, and for a while we've noticed that it had been appreciating. Now, in recent years, we've seen the renminbi as likely to go up or down. My own view, my own understanding of the People's Bank of China is that they have a bias towards keeping the renminbi as steady as possible, really to not disrupt trade, but to gradually encourage appreciation, really to put a control on inflation within mainland China, and ultimately to encourage the Chinese consumer. Because the period where keeping the currency cheap and relying on exports worked while it was very much an export gain, but the wealthier and wealthier Chinese consumers are getting, the more and more they want to buy things with their money, and encouraging a stronger currency is one way of encouraging domestic consumption. The other reason I wanted to show this chart as well was because I've sometimes been asked, can I really view the Taiwan dollar as a proxy for the renminbi or vice versa? Short answer is not really. Yeah, broadly they move together, but the Taiwan dollar is somewhat more volatile. And strangely enough, in some ways, the renminbi has become a lot more liquid with the advent of these futures, even though it doesn't move a heck of a lot more. So even though you may have bets or positions you may want to take one way or another, the focus really has gone a lot more towards the renminbi than it has on the new Taiwan dollar. But I provide you this chart here from the Bank of International Settlements, really more for your historic reference. So the second part of this chart, I wanted to show how has the renminbi and the Taiwan dollar, how have they traded since the 2006 depeg? So I hadn't moved to Hong Kong yet in 2006. I remember hearing on the radio when I woke up that morning that the big announcement was that the renminbi was being depegged from the US dollar. If you remember, for about 12 years before then, the renminbi was pegged at about 8.03 renminbi to the US dollar for about 12 years. And then suddenly they had depegged, they had revalued it, and they'd allowed gradual appreciation for a period of time until the 2008-2009 financial crisis. They kept it stable at around 6.8 for a while, and then they had let it strengthen again for a while. And then recently it had weakened again around to the 7 level. And I hear all sorts of different viewpoints of what to expect for the renminbi. One of the more aggressive commentators you might hear me arguing with on Twitter is someone who believes you might see an absolute currency collapse where the renminbi goes to 50 to the dollar within the next 5 to 10 years. I think that's an extreme case. But again, that is a position you can trade with futures if you've got a view on it one way or the other. I absolutely love hearing extreme viewpoints, by the way. So towards the end, I will give you my contact information. Please do share some of your viewpoints if you've got a view on either strong appreciation or devaluation. So that's enough about currencies. I next want to give a bit of an overview map about the greater China markets, because for those not familiar with it, it is a little bit of an alphabet soup. I mentioned earlier that there are basically two A-share markets in Shanghai and Shenzhen. Those were originally limited to domestic Chinese investors, later qualified foreign institutional investors, and it's now accessible through Stock Connect. That is the A50 that we're going to index that we're going to be talking about later. There is also the Msci China, which is meant to be a broader index tracking mostly H shares and some what are called N shares. Those are New York listed Chinese companies, and it's increasingly including more and more A-share companies through the A-share inclusion that we're mentioning. But it's still predominantly a Hong Kong listed and New York listed index of Chinese companies. Msci China does not include Taiwan. There are indices down here where, for example, you include the Golden Dragon and the All China plus Hong Kong plus Taiwan index. But this slide is meant to be kind of your overall map of all of the different Chinese stock markets and how MSCI has included them in all their different China stock indices. So, just as a brief overview again, A shares were originally limited to mainland Chinese investors only. They were open to qualified foreign institutional investors in 2002, opened via Stock Connect programs in 2014 in Shanghai, 2016 in Shenzhen. And then since 2014, they have traded an average of 15 to 40% premium over H shares. Now, on the other hand, you may have seen the alphabet soup of H shares, red chips, and P chips. So roughly 25% of the names listed in Hong Kong are actually mainland Chinese companies. They can either be H shares, which are incorporated in China and listed in Hong Kong, red chips, which are incorporated overseas, usually in Hong Kong, but they're mostly mainland Chinese assets, and P chips are incorporated in places like the Cayman Islands or Bermuda, and still mostly Chinese businesses and listed in Hong Kong. So Alibaba, for example, is an example of a P chip. These are mostly open to foreign investors, but mainland investors buy these as well for a program called the Qualified Domestic Institutional Investor Program. And now the ones listed in Hong Kong are also open on Stock Connect. So remember, if you're buying these, you're also competing with mainland investors. There are more ADR filings than there are A-share filings going the other way. So you may have heard of CDRs, where some foreign companies can be listed in Shanghai. Again, a very, very large map. Just very, very briefly, here's a snapshot from the Hong Kong Exchange of the Hong Kong listed H-share red chip versus the A-share markets in Shenzhen and Shanghai. I list this briefly for your reference, not to spend too much time going over it. On this next slide is one that I've put together from two different snapshots from the Financial Times, and it's really meant to show you how, since before Stock Connect, A shares went from trading at a discount to the same companies listed overseas to now trading at a premium. What that means is if on average you buy the exact same company listed in Shanghai as the same one listed in Shenzhen, on average you'll pay about 27% more for the same company if you buy it in Shanghai as if you buy it in Hong Kong. Now, if we want to look at this on a company-by-company basis, this next slide shows on a site called AA Stocks, shows the breakdown stock by stock. And you'll notice for some individual companies, this premium is even more ridiculous, more out of whack. For example, if you look at Luoyang Glass for the same share of stock trades at about 5 times as much in Shanghai as it does in Hong Kong. Yes, that is absolutely ridiculous. There have been all sorts of papers listed on why the A shares trade at such a premium to H shares. But you'll notice on the pie chart above, every single one of those AH stocks is trading at a premium on the A share market than the H share market. So one of the strategies I want to highlight in this presentation is if you want to buy H share companies and then sell the A share future to trade the AH premium, this is one way to do it, and this is one way of monitoring what that AH premium is stock by stock. Now on the next one, I want to look at a breakdown of the performance of these different markets. I mentioned, for example, the A share, H share, and Taiwan components. When I look at the A share, I specifically want to look at the A50. This is a narrow benchmark index of 50 A share companies. And we're going to look at those specific components, some of those specific sector breakdowns later. This compares with the H share. So the H share are Hong Kong listed mainland Chinese companies. And then on the other hand, we have the Msci Taiwan. This roughly shows that all three benchmarks are roughly correlated, but you have periods where one rises a lot more than the other and crashes far more than the other. A share broadly has been more volatile and since has risen more or less to a premium. This correlation is in spite of the fact that what's in these indices are actually quite different. The companies are very different. The exposures to different sectors are actually quite different. And these are overall different parts of the market, as we will see. So now when I talk about the different instruments we're going to use, this presentation has been co-sponsored by Singapore Exchange. And we see here that Singapore Exchange has 3 different asset classes really encompassing the Greater China trade. They have equity futures contracts, including the A50, the Msci China net total return, that's net of dividends, the Msci Taiwan, and then in currencies, they have Renminbi, that's both the onshore CNY USD, as well as the offshore CNH futures, and as well as 2 crosses, Euro CNH and Sing CNH. I'm really going to be focusing on the CNH futures. They do also have a Taiwan dollar futures contract, but it doesn't trade as much. That's why I haven't emphasized it quite as much. They also have commodities futures contracts, which again, I'm not going to emphasize because I already see I'm eating into a lot of time and I want to try to get through all these slides today. So let's talk about those indices. Let's dive into them. First of all, the A50. What's in the A50? Why do I not like the A50? Well, the A50 really is a lot of financials. And if I were to break down the A50, I would really break it down into two halves. The half that's financials and the half that's everything else. So what's in the financials portion? The biggest component by far is Ping An Insurance, and then you have several large banks, China Merchants Bank, Industrial Bank, CITIC Securities, China Minsheng Bank, and so forth. You then also have a few non-financial services companies, and the two largest by far are liquor companies, Guizhou Maotai and Wuliangye Yibin. Both of these make very highly alcoholic spirits, which are a very, very highly profitable business. But they're still mostly domestic brands. If you are not as much a connoisseur of Chinese liquor as I am, you may or may not have ever heard of these. But these are now two of the largest companies in mainland China. So the main thing that I point out is that if you like the A50, the message of the A50 is borrow a lot of money and drink very heavily, because that's what's in the index. And you can take long or short positions on that index with these futures. So that's the breakdown with you look at price to earnings, dividend yield, and so forth. But again, you got to break down. There's the financials and the non-financials portions of the A50, 50 stocks. Next, I want you to contrast this with the MSCI China. The MSCI China, as I mentioned, is a very, very different index than the A50. The two largest components are Alibaba and Tencent, which are tech giants. So these are your comparables to, say, an Amazon and a Facebook. And then later, as we go down, you'll see China Construction Bank. Ping An is there as well. Then you have China Mobile, JD, and another tech company, Baidu and NetEase. You will notice by far this is not a financially dominated or a liquor company dominated index. It's much more dominated by tech giants and consumer companies, a fair amount of which are listed on the New York Stock Exchange or NASDAQ or on the Hong Kong Exchange. So that's why, even though they are both ways of trading the the Greater China markets, they are fundamentally different indices. That's why, even though the A shares traded a premium, you'll notice the PE ratio of the MSCI China is 13.5 as opposed to 10.5 for the A50. The reason is the A50 has a lot of financials with low PE ratios, whereas MSCI China is more tech giants, where Baidu still may look like a value stock, but it's a value stock of a technology company rather than of a bank. Finally, I want to compare that with a breakdown of the very hardware-oriented MSCI Taiwan. You'll notice that officially, when you look at a breakdown of the MSCI Taiwan index, it is 56% information technology. But then when you look at the components, information technology doesn't mean the same tech giants you see in the FANGs or the BATJ. It's not Alibaba and Baidu and Netflix and Amazon. It's Taiwan Semiconductor and Han Hai Precision and MediaTek. It's kind of your older technology, and it's really hardware technology. When you think of tech giants, you're thinking of either mainland Chinese ones or American ones. You're not thinking of Taiwanese tech giants. If I ask you to name another Taiwanese company, other than materials and hardware companies, you might think of like a Cathay Financial or a Fubon Bank. But it does show on the streets of Taipei, you feel buildings are fairly old. It is a very, very different feeling than what you feel on the streets of Shanghai. So that's the overall picture I want to give you of these three indices: A50, banks and liquor; MSCI China, tech giants; and MSCI Taiwan, hardware. So let's go into a few of the different companies. Here I just wanted to present very, very quick Y charts showing two different metrics. When we look at banks, the metrics I look at is I look at return on assets, how profitable are these banks, and price to book. How cheap are they? What are their valuations? Briefly, without any more comment, I'm just going to show you this Y chart of the top three financials in the A50 index. Now, financials are important. I mentioned whether you're on the long or the short side, the A50 is very, very valuable because one of the biggest risk factors to look at in Greater China is a banking crisis. There's been no doubt that since the global financial crisis, the level of debt in China has been rising. So if you ask me, why do I not like the idea of just passively indexing China, just buying an emerging market index fund and calling it a day? The reason is that it includes a lot of Chinese banks. And if I like to invest, even though I like to invest in China, I'm not so big on the financial sector because I'm not as confident on their balance sheet. I'm not so confident on their loan loss reserves. I'm not so confident on when the Chinese government wants to jumpstart the economy, that they're not going to force a lot of the state-owned banks to bury lots of bad loans and so on just to keep the economy going. That overall will be great for the Chinese economy, but that will not be great for shareholders, especially minority shareholders in Chinese banks. So that's something very much to watch out for when you want to look at your sector exposure in these different areas. Now, once again, that is my view. You may or may not disagree with me on how Chinese banks are going to perform, but that's one reason I think it's important to look at that sector. So I mentioned earlier that besides just borrowing lots of money, the other thing in the A50 is lots and lots of liquor. This is a quick chart just showing you how really these two companies were real outliers in the A-share market. So again, these two, if you haven't seen these bottles before, Guizhou Maocai and Wuliang Ye Yibin, if you go to a duty-free shop, and I've seen even the duty-free in Chicago and Washington Dulles and other areas, you'll see these there, and these bottles are not cheap. A bottle of Guizhou Maocai, for example, will probably cost you about 300 to 400 US dollars, about 2,800 RMB or so. Wuliang Ye Yibin might be slightly cheaper, but it's expensive premium liquor because if Xi Jinping were to go meet Donald Trump, this would be served at those banquets. That's the level you're talking about. Same exact thing if you were to go to an expensive wedding or so on like that. And the inputs to these are basically water and sorghum. So these would be the Coca-Colas of the A-share market if you wish to compare. So I've again included some snapshots here just so you could be familiar with. Now on the MSCI China, I mentioned BATJ. BATJ stands for Baidu, Alibaba, Tencent, and JD. And here, again, I just wanted to include two running financial charts. Now again, these are not stock prices. This shows revenue and cash flows for Alibaba and for Tencent going back 5 years, just so you can see how these companies have been growing, not just in terms of their stock price appreciation, but in terms of real cash profits over time. Now, by comparison, I wanted to say, what about Taiwan Semiconductor? If we wanted to compare Taiwan Semiconductor to another company, we might compare it to, say, Intel. This is a chart of the market cap of these two companies by comparison. All the way back in 2000, of course, Intel was a much, much larger company. Taiwan Semiconductor surpassing Intel was, again, one of these things you may or may not have noticed if you haven't been paying attention to markets over here. But the thing to worry about with Taiwan Semiconductor is, has it become the Nortel of Taiwan? Has it become too big a component of one market that we need to worry about concentration risk and might want to trade one side or the other relative to the index? So now let me get into the specific contracts. The first one I wanted to mention was the A50 futures. I mentioned you can go long or short this contract, but the A50 future is one of the most liquid equity index futures traded on Singapore Exchange. Here you can see there were 71,886 contracts traded on this one day that I happened to take this snapshot of the A50 futures. I also want to show you the roll yield. The roll yield is the difference between the May and the June, or really between any two futures contracts. If you are buying and rolling these, this is effectively how you get the dividend yield and the securities lending revenue. On the other hand, if you are selling these futures contracts, that is basically your borrow cost built into that. The reason that roll yield is there is this is just about the only way that you can easily short A50 futures. If you don't have an onshore presence and are able to trade the CSI 300 futures in Shanghai, this is pretty much your only way to short A shares. So if you want to go long H and short A, this is really the futures contract you got to use, and that's one reason the volume on this contract is so high. So next screen, I just want to give you a bit of an idea of what the trading screen for this A50 futures contract is going to look like if you want to do one of these trades in your Interactive Brokers account. The multiplier on this is just $1 US, and this is a US dollar denominated contract. So if you were to trade one, the notional amount is about 12,000 or so US dollars of exposure. Now that said, with any futures contract, you don't have to put all that money in your account at once. I show the margin limit on the lower right, and here you'll notice the trade that I'm putting in is a sell. So I'm shorting the A50 by selling one contract here, and you'll notice the impact on my margin balance for this particular account before and after the trade. shows the initial margin, maintenance margin, and so forth like that. So overall, if you're holding the A shares and you want to sell this against it, this will give you an idea of how much margin you'll need for that. So on to trading strategies, I'm going to give you a bit of the why buy, why sell this particular future. Now, one, this is a USD hedged, capital efficient offshore access to A shares. So the A50 index is there, and you're trading it in US dollars. So there is no component in there where if the renminbi moves, it's not going to affect. You're looking at the index, and if the index goes up 1 point, you make a US dollar. If it goes down 1 point, you lose a US dollar. The roll yield, as I showed you earlier, the difference between 1 month contract and the next, is about 6 to 8% per year. So in other words, if the index doesn't move and you just roll the futures, you would make 6 to 8% just on a roll yield. The other way of looking at it is if you're buying and rolling it, the index would have to fall by about 6 to 8% a year for you to just break even. If it just stays the same, you make that yield, and it would have to fall even more than that for you to lose money by buying and rolling. In other words, you are making a yield by providing shorting services to those who want to short the A50 with this. Also, the nice thing about these futures contracts is that it's all rolled up. You don't have to worry about dividends, corporate actions, other things that come with buying and holding and rolling stocks. You can use it to bet on a widening of the AH premium. So in other words, I showed you that the A shares premium had gone wider. A shares had gone up while the A shares hadn't gone up as much. So if you want to short 8 shares, which you can do here in Hong Kong, and bet the A shares are going to go up, you can buy this future and trade it the other way around. Now, why would you sell these futures contracts? You can beta hedge your exposure to A shares. Let's say, for example, you've gone through Stock Connect and you've bought 10 to 20 A share companies that you really, really like, maybe really, really good companies. But you want to hedge the exposure against the overall decline. Well, you'll have to pay that roll yield. You sell these futures contracts, and you do it the exact same way as if you bought 20 really good US companies and sold S&P futures or so on. So that's one reason you'd want to do that. You could also use it to offset your China exposure in an EM portfolio. If you own a total world fund, like it or not, more and more of that all world fund is going to be allocated to A shares. If you want to offset it, you can sell a few of these futures contracts. Another thing you can do is you can fine-tune or hedge out mainland China financials exposure specifically, or also liquor exposure specifically. As I mentioned, 50% of this is in financials. So even though you can't really isolate it, if you sell these futures, you can really look at it as a hedge specifically on the financial sector. And contrary to the other side of the slide, you can use this to bet on the narrowing of the AH premium. So if you believe that eventually it's got to collapse because the markets are going to get more efficient, you can buy the H shares, sell the A50 futures, and bet the two are going to narrow. That hasn't worked for 5 years so far, but maybe when you start, maybe you'll get lucky. Next, I want to move on to Msci China. You will notice quickly that these futures are not quite as, we don't have quite the same volume of the A50, but really not too bad. In this case, when I took this snapshot, there were 43,000 contracts of the June futures that were traded on this particular day that I took the snapshot. So still not too bad, but when you consider again, this is a very different index than the A50. Looking on the screen, I mentioned that despite the lower volume, the lower number of contracts, the dollar value of these contracts are a little bit higher. So instead of say $12,000, you're talking about 42,000 US dollars value per contract. There's about 10,000 US dollars of initial margin, 8,000 of maintenance margin that more or less you've got to keep aside. Again, I'm assuming here that we're going to be selling one of these futures contracts. The mechanics of it, again, look more or less similar to any other futures contract that you might trade. Now, why buy? Once again, you'll notice that this is a US dollar denominated capital efficient way of accessing the MSCI China benchmark. So let's say if you're a young investor, maybe you don't want to push the margin to the absolute limit, but let's say you've got an account with $30,000 in it, and you want exposure to $40-some thousand of MSCI China. You can buy and roll these futures contracts. That's one way to get a little bit of leverage. Your net dividends are already priced in. So unlike the A50, where the dividend is effectively priced into your roll yield, the index that you're trading here is a dividend of net total return of the MSCI return net of the dividend withholding. You could do this as a spread trade versus the A50. So in other words, you could buy this and sell the A50 futures or vice versa as a way of trading the AH premium. Now again, this is not purely AH because a significant component of Msci China is N shares or futures that are listed and traded in New York. So keep that in mind when you look at, should I trade Msci China or should I trade, let's say, the 8-share futures listed in Hong Kong against the A50 in Singapore or vice versa? Nice thing about the Interactive Brokers account, you can trade on the Hong Kong Exchange, Singapore Exchange, CME, all fairly easily in one account. Now, why would you sell this futures contract? Same exact reason you might sell the A50. You want a beta hedge against not your A50 exposure, but your Msci China exposure. You want to offset the overall China exposure, not just your A-share exposure in an EM portfolio. And just like you might want to focus on hedging out your financials with the A50, here you could view this as a basket trade to hedge out BATJ, specifically your Baidu, Alibaba, Tencent. This may not be quite as critical because, as you know, it is a lot easier to borrow and short Alibaba stock in New York than it is to borrow and short any A share. But again, this is one reason that you could use this, especially if you prefer futures contracts. Next, we want to move on to Msci Taiwan. So once again, this is a fairly liquid futures contract, but what's important with this one is it does provide access to a market that you might have otherwise not been able to trade single stocks in. So over here, you'll see almost 50,000 contracts traded this one day, which again is not bad when you consider each one of these contracts is worth about 41,000 US dollars. I again show the screenshot here to give you an idea of what the size of the contract is, impact on initial and net margin and so forth. But overall, once you're familiar with futures trading, each one of these is going to look fairly familiar to you with how it appears in your account. So why buy? Now, this again gives you US dollar hedged, capital efficient offshore access to Msci Taiwan. You'll notice, unlike Msci Singapore, which also trades in Singapore, that trades in Singapore dollars, this trades in US dollars and is a way of accessing Msci Taiwan. It has a significant roll yield. So if you buy it and roll it, you'll make money if the index doesn't move just from the fact that every month you're buying at a lower and lower rate. That basically gives you the benefit of the dividend without having to worry about withholding taxes, dividend withholding, corporate actions. If you were a non-US investor, so let's say if you're based in Singapore, you're based in Hong Kong, you're based in a country with no tax treaty with the US, that's much better than buying EWT, the iShares Msci Taiwan, listed in the US, which would have a 30% withholding tax when that dividend comes to you, going from the US to your home jurisdiction. You could also, if you wanted to trade this relative to mainland China, you could do a trade where you say buy Msci Taiwan and short Msci China or vice versa. There are lots of spread trades you can do if you believe, let's say, there's going to be a good recovery in hardware because it's overall a cheaper index, or trading at cheaper valuations and vice versa. Now, why would you sell? You could use it as a short beta hedge, specifically to Taiwan Semiconductor or to Msci Taiwan more broadly. You could short it as a hedge against hardware. So one way of thinking of it thematically is you say wanted to go long software, short hardware. So that would be implicitly done in a Msci China versus Msci Taiwan, but that's kind of what you're doing when you're doing one index versus another. You can also bet that Taiwan is going to outperform mainland China or outperform other EMs. You may think, for example, that a lot of electronics manufacturing is going to move to Vietnam or to Bangladesh or, who knows, somewhere else. That really depends on what is your view on the overall Taiwan market versus the rest of the rest of the region. That's why, again, I feel you can't just look at Taiwan as a country. You have to look at the index components and see how profitable are they going to be and which of these are going to make you more money over the next 10 years. So a little bit on volume. These slides provided by Singapore Exchange, I wanted to contract them and squish them. So sorry for the visual being a little bit tight, but I wanted to show you that the volume of these contracts has been broadly rising. So I showed you how many thousands of contracts were traded on any given day. Overall, unless you're a really, really, really large market-moving trader, you shouldn't have to worry about liquidity on these. I don't trade Msci Taiwan quite as often. I trade A50 a little more often, Msci China as well, but I've never had problems getting a fill. quite unlike other presentations you may have seen when I talked about India single stock futures that don't trade as much. These are among the most liquid futures you're going to see on these benchmarks really anywhere. Now, next, I want to briefly talk about currency. I know we're a little bit over on time here. Every now and then I will see on my LinkedIn SGX talking about how volumes on CNH futures in Singapore have surpassed those on Hong Kong Exchange. Obviously, if you know the rivalry between the two exchanges, one always likes to look at the other. Me as a wealth manager, I really don't care. If I can get a good fill, good margin limits, if I can trade my renminbi on one exchange or another, to me, they are effectively commodities futures or commoditized futures. But this is a snapshot of what the so-called roll yield or forward curve, futures curve, looks like for renminbi, and how you'll not just see liquidity in the front month, but you could trade, for example, June 2021 and still get a degree of liquidity all the way out there and be able to pick up the difference in yields that way. Here's a screenshot with the example of the execution if I wanted to sell one of these renminbi futures. You will notice the way this is denominated. The contract is the price of $1 in renminbi, and this contract settles in your account in CNH, an offshore renminbi. So the values and everything else, all of that is going to be in renminbi. So just watch out for that if this is how you want to trade the currency. Now, in terms of liquidity profile, one thing that Singapore Exchange really was happy to provide me these graphics on is they want to show how much of the volume has been occurring in the T+1 session. That basically means after hours. So in other words, even if you're not awake during when Singapore and Hong Kong have their business hours, if you're in London or if you're in New York and you want to trade renminbi in those business hours, you can trade them in Singapore just as easily as you can trade them in Chicago. Clearly, these exchanges want to compete for our business in providing that. So overall, what they wanted to show you is that 35% of their renminbi futures volume was traded in the T+1 session. So again, just a quick why buy, why sell. You could buy this futures contract if you want to hedge the renminbi exposure of a renminbi-denominated bond, pension, or other future flow into US dollars. So let's say, for example, you bought an RMB bond, or you have a pension from mainland China. You can use this contract to hedge that. You can also use it to hedge your basis between A shares and A50 futures. Remember, if you buy A shares through Stock Connect in your Interactive Brokers account, those are in renminbi. But if you sell A50 futures, those are in US dollars on a renminbi index. There is a currency mismatch between the two. And if you believe the person who thinks that the renminbi could move big one way or another, you might want to hedge that currency exposure. And that's one way of doing it. The other thing you could do is you could bet on the devaluation of the RMB. And in order to do that, you have to remember the roll yield accounts for the fact that renminbi interest rates are 1% higher than US dollar interest rates. So renminbi has to devalue by more than that interest rate difference in order for you to make money on that trade. Now, why would you sell these futures? Let's say, for example, you went and retired in mainland China and you've got US dollar bonds. And you're worried that the dollar is going to devalue, the renminbi is going to appreciate. Well, you sell these futures to basically turn your dollar-denominated bond or pension or other cash flow into renminbi. You can also use it to hedge the value of USD trade or commodities receivables. So even though I'm assuming I'm mostly talking to traders, wealth management clients, individuals who want to invest in China or outside of China or so on, even if you're running an operating business, you just want to open this to hedge your currency exposure, that's one reason you might want to use these currency futures as well. You can also bet that the USD will devalue against the RMB. If you believe Jim Rogers, for example, he believes the renminbi could become the world's next reserve currency. So there are different viewpoints on that, but I find it easier to invest in stocks than to try to bet on currency directions. That's one thing you can do with these. The other thing, of course, is along with betting that currencies aren't going to move, you can earn that interest rate differential between the two. In one of my workshops, I explain how to use these futures contracts to basically turn a U.S. Treasury into a renminbi-denominated bond. So that's all for today's presentation. Hopefully, you all found it useful and learned a lot. I know I did go through an awful lot of material here. I just want to quickly go through. I noticed, okay, a lot of questions here. Let me scroll down and see if I can scroll through some of these questions here. So question number one. So now, first of all, before I go on to the questions, I want to make sure that you all have a way of connecting with me. I do have my WeChat QR code here because I know a lot of attendees interested in mainland China will often look at WeChat, so by all means scan that. And you can also find me on email, my website, Twitter, and also on Seeking Alpha. If you look up my name, Tariq Dennison, on Seeking Alpha, I'm the only Tariq Dennison in the world. I've written lots of articles on China's ETF, single stocks, and so forth. So let me try and quickly go through some of the questions here. I am not allowed to trade Singapore, hold on. I'm not allowed to trade Singapore stock index futures, e.g. Msci by IB. I'm currently an IB client and think I'm disallowed because of Singapore resident status. Why is there such a restriction? Sorry, I have no idea on how to understand permission restrictions on that. That would be something I would direct towards Interactive Brokers.
Eric, Cynthia here. If I could jump in, it's that restriction is due to regulatory considerations, and IB currently is unable to offer trading in Singapore stocks and SG-denominated futures to Singapore residents. We do hope to offer this availability in the very near future. So just did want to comment on that.
Excellent. Thank you very much for answering that, Cynthia. So great. Let's see. So thank you for your reply. Okay, great. Next one. If SGX is serious to get more trading volume in its product, it should remove bad practices. Okay, got it. Okay, yeah. So sorry, that was a. I think that was related to the regulatory restrictions. Thank you for the presentation. Okay, we have another question here. Quick question on COVID. Do you think the QE in China would end up pumping the share market, especially when Shanghai and Shenzhen index are at relatively low levels for a while? Thank you. So short answer is, whenever you have more money chasing the same number of companies, the same number of assets, that tends to push asset prices up, understandably. We've already seen that in the US with the Fed. A very common question I've been asked is, how on earth is the NASDAQ up for the year, even when the US is facing the worst jobless numbers, the worst recession, the worst economy that it's seen since the Great Depression? The short answer a lot of people give is the Fed is just that you simply have more money going out there pumping at it. I think there's certainly a degree of that where you have more money chasing assets for a while. The thing is that even though economics is not the same as physics, you ultimately have a conservation law. When you have more money sloshing out there, eventually you've got to have one of a few things happening. Either you're going to have inflation, so yes, you're going to see asset prices rising, and it's going to come with the devaluation of the currency, or you're going to see eventual tightening and austerity later as that gets reeled back. That's effectively what we've been seeing in Europe for the past 20 years. It always has to come from somewhere, because if you think of when you buy a share of a stock, you own a piece of a business, it's only going to ultimately give you a good return if that business is bigger and produces more things 10, 20 years from now. If inflation eats all of that away, it doesn't really do you any good. But my own view is that's why I think you really need to look at sectors, because the way China has done QE is quite a bit different than how it's been done in the United States. And as I mentioned, my own personal and professional view is that you're going to see Chinese banks eating and digesting a lot more bad loans than U.S. banks will face, and it may in some extent look more like how Japanese banks have been dealing with it for the past 15 years. So my own view is I think it's ultimately going to pump up returns for many of China's other sectors, but it's not going to be so good for China's financial sector. That's why I'm very wary of the A50 specifically. So I hope that answers your question. Even though it may do some things for a while, I'm looking at what are the total sum of profits these different sectors are going to make over the next 10 to 20 years. Next question, what is my view on the banks? Bank A shares, e.g. ICBC, China Construction Bank, the prices have been quite stable, no major movement. So short answer is I don't look at stock prices too much, other than I find them volatile. I try to buy low and sell high when possible. But overall, fundamentally, I don't like financials. I mean, yes, some of them have had decent, return on asset ratios. Yes, they're trading at discounts to book value. But ultimately, if China has any debt crisis, that's the area that's going to be the most hard hit. One canary in the coal mine, if you will, is you look at HSBC. HSBC recently had to eliminate their dividend. And I wrote an article saying that should have surprised nobody. Now, if anything, they've got branches, they've got intelligence all over mainland China. They should have known, they should have seen this coming. Yet still in late February, they declared the dividend that they had to end up canceling a month and a half later. That, if anything, should have been quite embarrassing for HSBC. Now, HSBC is a more international bank. If ICBC or CCB did that, I don't think they would get quite as much press. But ultimately, as I think we've seen, whenever we see sources of stimulus that need to go through the system, China, who owns a large stakes in many of these banks, will tend to push it through the banking system. And I ultimately believe it's not going to be great for many equity holders. So you may see cuts in some of those dividends. Overall, I can't comment too much on short-term share price movements, because what I care about is if I have a choice between buying China Construction Bank or Guizhou Maotai or a healthcare company and holding it for 10 years, I want to buy the share in the company that's going to earn the most profit over the next 10 years. And I hope to buy it when the price is low and not really have to look at the price for a period of time. So that seemed to be most of the questions there. If we've got nothing else, I know I've kept everyone a little bit past their time, but does that sound good, Cynthia?
Oh, Tariq, thank you very much for a terrific presentation. I also want to thank everyone who's joined us here this evening for your participation. Also, a quick reminder that we have been recording today's event. We covered an awful lot of information here, and each of you will get a direct link to today's recorded playback soon after the session ends. So if you do want to come back and review these concepts, simply watch your inbox later on today for those direct links. By the way, I also want to point out in the handout pane that's included in your control panel, you'll find a PDF copy of today's presentation is available there for download. And we'll also be posting today's information on the Interactive Brokers website. By the way, we have a terrific library of other presentations that Tariq has done with us that are available with the link that I'll be sending you later on today. And finally, I do want to expressly thank our exchange partner, the Singapore Exchange, for making today's event possible. So with that, we are going to conclude our session here today. Thanks so much, everyone. You can exit using the X in the upper right-hand corner of your screen. Thank you so much again, Tariq. Terrific presentation, and have a great rest of your day, everyone.